Hello and welcome back to Miss Finance. Today we're going to have a look at ethics scenarios that you might face in the exam. So I'm going to very quickly cover the 5 fundamental principles, which are objectivity, confidentiality, integrity, professional competence and due care, and professional behaviour. And there are also 5 risks that you might see in the exam as well to those 5 fundamental principles, and they are intimidation, self-interest, self-review, familiarity, and advocacy. So I'm not going to go over those in a lot of detail because there are prior videos with all that information on, so I will provide a link below and a card above as a quick link to help you there. Otherwise we're going to jump straight into the scenarios. So we're going to have a look at a situation where an accountant receives an offer for a loan from a client. So imagine John Smith is talking to the client about the fact that they're trying to raise finance in order to expand a firm, and the client the next day decides to offer the accountant the loan. Now this would solve the issue of raising more finance. However, should John Smith actually accept the loan? The answer would be no, because this actually poses a self-interest threat and could affect the objectivity of John Smith when preparing this client's accounts, because they'd be less likely to want to offend or disagree with the client when preparing the financial statements. Scenario 2. Imagine that there is a post-year end meeting with the accountant and their client, and they're discussing future strategy with the client, and the client's looking to go into a joint venture with somebody, and they decide that actually it would be a great idea if they entered into a joint venture with the accountant. Now in this sort of situation, do you think that they should accept going into a joint venture with the client or decline? In this scenario, you also have a self-interest threat. So again, the accountant's objectivity might be threatened, so they would have to politely decline. Now, examples of other self-interest threats that you might see in the exam could be the likes of a financial interest around losing a client, contingent fees relating to an insurance engagement, where an accountant is heavily reliant on the fees of a client, say if they're the largest client that they have in the firm, for example. So in scenario 3, so imagine an accountant has worked at a firm for 15 years and then decides to move on to another practice and is made tax partner there. Now, after leaving, they receive a phone call from the previous employer asking if the firm that they now work at, so the tax firm they work at now, will come in and become tax advisors for this accountant's old firm. So what considerations should we make here, and what potential threats might occur? So you've got to consider that there is a very, very high self-review threat here, because if that individual was doing the work in the firm beforehand, then working at this new firm now, they would potentially be reviewing the work that they had done whilst working at that firm. Now, one way to mitigate that risk would be to use other people within the new firm who have no prior connection to the firm that the accountant worked at beforehand, so there would be no self-review threat. But again, if there's adequate safeguards in place, then potentially yes, you could take on this work, but if you're unable to lower those risks to an adequate level, then no, you'd have to decline the work. Other self-review threats that you might see in the exam are the like where you have an accountant who's asked to prepare a set of accounts and then is also asked to audit those accounts. That stands as a self-review threat. Or you might have a situation where an accountant was involved in the implementation of a system and the creation of that system, and then asked to prepare a report on the operation of that financial system. That would also count as a self-review threat. Heather is a professional accountant, and her brother's wife runs a fitness business. And up until this point, they've been able to do their own bookkeeping and keep on top of it, but they have expanded rapidly, and they've now gone to Heather and asked if she could take them on as a client. Now, Heather doesn't work for a firm of accountants. She is a sole trader effectively. She's working on her own. So should Heather accept this assignment? So the answer there would be no, because this poses a familiarity threat. So she might be more sympathetic towards her brother's wife and might not be fully objective when preparing the financial statements. Now, other types of familiarity threats that you might see in the exam is where an accountant has a long association with a client. So if they've worked on a client's financial statements for many years and continue to do so, then there might be a familiarity threat, and they might be less likely to question or have a fully objective view when preparing the financial statements. So let's have a look at another scenario. So imagine a scenario where you're at a client's and you're undertaking an audit, and you've been asked to perform the sales walkthrough test. But before you get on to doing that, the finance director of the client asks you to come into their office and have a word. So you sit there and the finance director briefs you exactly how the audit's going to go, and they tell you that they expect you to find no errors in the workings, and that they don't expect that there'll be very many questions, as there haven't been before, which leaves you feeling a little bit pressured. What sort of threat has arisen in this case? So this would be an intimidation threat. There is a pressure here to agree with the client and to not question and to not look into things in detail, because the finance director is basically saying to you that they don't want you to find any errors. So if this ever happened in practice, you would go and tell your line manager immediately. Now, other types of intimidation threats that you might see in the exam are threats to be dismissed by a client if you don't agree with them or you don't change the financial statements, or the threat from a client not to award you the work again next year because you've disagreed with them. Threats of litigation, so threats of taking legal action against you unless you do something that the client is asking you to do, i.e. not change a figure in the financial statements when you know it's incorrect or it's material, or the pressure to reduce the quality of work in order to reduce fees in future. So let's move on to the last one, which is an advocacy threat. So imagine a scenario where it's the year-end audit meeting and the client has said to you that they've now got a new listed company and they want you to share that news with the rest of your clients so that they can boost the number of shares that they are able to sell. So this would constitute an advocacy threat, because if you were to do this, then you'd be promoting that client or acting as the client's advocate. So an advocacy threat is where you're going beyond your advisory role and where you're actively speaking on behalf or in support of a client. So lastly, let's just run through some very quick safeguards that you can put into place in practice against the 5 threats that we just mentioned. So you could make sure that there are documented internal procedures and policies requiring compliance to the fundamental principles and disciplinary action for those who don't adhere to them. There could also be timely communication of these policies via email or via a training day for all staff members. So as always, I hope you found this video useful. Consider subscribing and I shall see you on the next video.